All right, let's reinforce your learnings from the previous video about debit and credit and do a quick tutorial. On the slide, you see name of an account. So we have cash account here, and we've been given a direction of change. So how to interpret this is as follows. The slide is telling us that due to a transaction, cash account in the business has experienced an increase, meaning more cash has come into your hand. Now you have to respond by saying whether cash account should be debit or credit. Should it be debited or credited? That's how we use these two terms as well. So let me do this quickly. Now, cash account is experiencing an increase, which means there is an increase in the claim of the business on the new cash that the business has received. Increase in claim is debit, right? I don't think any justification is required. This is fairly straightforward. Then you have bank balance. So you're going to call it, let's say, bank account. Bank account decreases. Now, when does bank account decrease? Bank account decreases when possibly you have paid salaries, when you have paid to creditors, when you have paid any other expense is being paid. It can be a liability which is being repaid. So let me just write those two as well. So a liability or an expense can be repaid or paid, right? In any of these two cases, you pay through your bank account. It could be through check or online transfer. So banks claim on the bank balance, sorry, not banks claims, but businesses claims on its bank balance are going down. So decrease in claims, and decrease in claim is credit, right? Remember that there must also be an equal debit. All debits have equal credits. So when you say bank account credit and you are paying to, let us say, paying salaries, you're paying to employees, and a debit, an equal debit has to be given to salaries account. But we are only discussing one side of the coin. We are taking baby steps. One by one, we are learning, what should be debit, what should be credit. And in the following videos, we're going to stitch everything together and we're going to look at both sides of the coin. Next up is office equipment. Office equipment increase. When do office equipment increase? They increase when you purchase them. So you purchase them. You could purchase them on cash. You could purchase them on credit. Right? Does not matter. If you purchase them, then your claims are going up. Businesses claims are going up on that particular asset or office equipment in this case, and you will write a debit. The opposite of this, the other side of the coin, is that you have paid in cash. If you've paid in cash, then cash account should be credit because your claim on cash goes down. And if you have not paid in cash, then this creditor has a claim on the business. So there is a new liability that you have. Again, increase in liability is credit because the creditor has a claim on the business in this case. So a debit is going to have an equal credit, but I'm refraining from going into the other side, but I'll start doing it, as we move forward. Rent for building. If you remember, rent is, rent when you pay gives you a right to use the resource, to use the property. So there is an increase in the claim of the business over the use of this asset, which is called building here. Please remember, rent does not refer to the money that is being paid. That is cash account. That is separate. Rent represents the right that you buy over the right to use that resource. Therefore, the claim, the right is going up here and you would write a debit. The other side of the coin is going to be that rent is being paid, so right is going up, but what is also happening is you are paying cash for it, so your claim on the cash is going down. So the other side is that you do a credit to the cash account. More on that as we move forward, but I'm giving you a preview of what is to come in the next videos as well. Electricity bills increase. So electricity bill is an expense item. It's an expense item, and you pay. Let's say you paid the electric bill. By paying the bill, you earn the right to continue to use the electricity, the power source, right? So it refers to increase in the claims of the business over the use of this service, which is electricity, supply of electricity. So you're going to do a debit to indicate that your rights, your claims are going up. Again, the other side of the coin is that you paid money for it, which is cash account. Cash account will see a reduction. Businesses claim on its cash will go down because you have paid that cash to the electricity company, to the government, and you can't demand that back. And if you've not paid, the government will demand that money. The supplying company will demand that money from you. So for now, claims of business go up on the use of the supply of electricity. Therefore, we write a debit here. Next up, you have shareholders capital, which is increasing. Why is shareholders capital increasing? Because shareholders brought in more money. Shareholders bring, let's say, more money into the business. When shareholders bring more money into the business, what is happening? What is happening is businesses' claims are going down. If you remember, this is the shareholder. Shareholder brings in a new 100 rupees into the business. Now there is a new liability that has been created. Business owes this money back to the owner at whatever point it is due, equal to 100. This is the cash that owner gives to the business, but in return what is happening is shareholders capital. The name of the liability is shareholders capital. Shareholders capital, and this is what is going up. Shareholders capital is increasing, which means there is a reduction in the claims of the business because shareholders claim on the business is going up, right? So any reduction in claim is credit, shown by credit. So we're going to write shareholder capital account and write the word credit opposite to it. And somebody who knows the accounting language will be able to interpret, will be able to infer that shareholders brought in more money, more cash into the business. Therefore, the liability of the business toward the shareholder is going up. That represents the reduction in the claims of business, and hence the credit has been written there. Then you have purchase of goods, which is increasing. So you are purchasing the goods. You are more goods are coming in. So you have purchase account, which is going up because goods are coming in. So goods are going up, which means claims of business on these goods is going up. So I'm going to write plus claims, which means increase in the claims of business, which is represented by the word debit, and you're done. Sale of goods. Sale of goods, again, you're going to have a sales account. When you are selling goods. When goods are being sold, there is reduction in the right of the business over these goods because you have sold these goods, you have delivered these goods. So goods are going out. So let me say reduction in the goods, in the claims on the goods, and consequently the reduction in the claims of the business. So I'm going to write minus claims and say credit. Again, remember that sales is typically thought of as an income, as a good thing, as a positive thing, and debit represents the increase in things, right? However, I've told you there are two sides to a coin. The thing that you are thinking is cash that you receive against the sales. When I see sales, I mean goods, and goods will have to go out minus goods will have to go out for you to make this money. This is the cash that comes in. So do not confuse the two. In accounting language, we learn to segregate the transactions. We see through the transactions in, and we categorize them into two aspects, give and take. What is the debit and what is the credit? That is what double entry system is. So in this case, we are right now talking about the goods which are going out, meaning businesses claims are going down. Therefore, we write a credit against the sales account to indicate that goods are being sold. Then you have carriage on purchase. Carriage, as I earlier said, it's an expense item. It is a transportation cost. Transportation cost. All right. So what is happening here is it is increasing meaning you paid it in the account, in the carriage on purchase account. You show an increase because you just paid carriage. So by increase, we do not mean earlier the carriage was 100 rupee per kilometer and now it is 200 rupees. Not that increase. We are saying in the record that you are keeping for all the transportation cost, there is one more item. There is an addition to that. So when that happens, it means you have a right over the use of the transportation service of the vendor, or whosoever owns the vehicle, a company. So when you have the right over the use of vehicle, the claim of business is going up. So you say debit. So you're gonna write carriage on purchase account debit. It means that you have a right to use this service of transportation because you have paid for it. The other side is that you have paid cash for it. So your claim, the business's claims on the cash will go down, but business's claim on the service, the use of service, right to use the service, that will go up. And carriage on purchase represents that right, not the cash that is paid. All right. Then you have duty on purchase, a similar item. Again, this is an expense. When you pay the expense, you have increase in the right of the business over the use of a resource, or the business has more claim on that service. It is indicated by debit. Motor van decrease. Now, what does decrease in vehicle mean? So this is motor van account. When you would have purchased, let us say, purchased the vehicle for 100. At that time, you would have shown a debit because you paid cash for it, and vehicle is coming into the business, and you've bought the vehicle. You have the right over the vehicle. The registration is in the name of the business, possibly. So you shown a debit at that time. Now, when would there be a credit? And of course, as we understand, debit and credit are opposite to each other. One represents the increase of the claims of business. The other one represents the decrease. So when you purchase the vehicle, you show a debit. Now, clearly, the opposite of purchase is going to be sale. So when you sell the vehicle, sale of vehicle, let's say you sold it for 50 because over a period of time the value goes down as well. So you sell the vehicle for whatever 50, but effectively what is happening is you are reducing the value of the vehicle. And if you want to keep it simple, let's say keep it 100, because then there is whole question of the value is going down and what price you are selling. We'll deal with those advanced questions a little bit later in the course. Let us say that you bought it for 100 and next day you sell it at 100. Again, not possible. The value of vehicles goes down by 20 to 30% immediately after they get out of the showroom. However, hypothetical situation. You sell the vehicle, 1,000, your claim on the vehicle goes down because you would have received cash against it. So reduction in the claim is shown by a credit, right? Okay, furniture increase. Your claim on the furniture is going up. Furniture is, you purchase more furniture. That is the clear explanation. You purchased more furniture. So in the furniture account, you're going to write a debit because you've paid for it or you will pay for it, and you have an increase in the claim of the business on the use of the furniture. Land increase again. When land increases, it's not increasing in size. You bought more land. You added more land to your existing pool of land is what we mean here. So I'm going to just quickly write for hints that you purchase more land. That means you have claim on more land. Your claims are going up in that sense. Any increase in the claim is debit. Salary to staff. Salary is being paid for the services. So the business has a right over the use of staff services. That is what it means. When the salary has been paid, when you say salary account is increasing, it does not mean monthly salary has a 10% increment. It does not mean that. We are saying up till now in the, again, let me take a financial year. So April 2020 to March 2021. So every month you pay salaries. Let's say these are, monthly breakdowns. Every month you pay salaries. You have 10 employees. Everybody is paid, let's say 10. So every month you spend 100 on salaries. Okay. So you pay 100 in the first month. In the salary account, you show 100. In the next month, you add another 100. This is what I mean by increase. In the following month, you add another 100. And the total salaries till date are 300. Next month, you pay another 100. Total salaries are paid till now are 400. So this is what I mean by increase in salary. Whenever you add more to the record, to the book where you are maintaining the records for salaries. So when you do that, you pay more salaries, your claims are going up because you have a right to use the services of those staff members, and any increase in the claims of business is represented by the word debit. You have interest on loan which is increasing. Again, increasing does not mean earlier you were paying 8%, now you are paying 10%, which could possibly also be the case, and we'll deal with that later as an advanced case. But we are saying interest on loan has been paid now. In the interest on loan account, you just wrote a new item because after, every month, let's say you pay interest. So when you paid interest for the first month, it was 10, and now you paid another 10. Accumulated interest that you've paid is 20. So from 10 to 20, this is the increase. This is what we mean. So when we pay the interest on the loan, what is happening is you are paying the rent equivalent to rent paid for office premises. When you pay rent for office premises, you earn the right to use the office premises. And when you pay interest on loan, you earn the right to use the principal amount of the loan for the business. So it also represents increase in the claim of business. As long as you are paying the interest, you are eligible to use the loan. If you stop paying the interest, the bank will, stop this service and they will demand repayment of loan from you. Or if it is a secured loan, which means, you have given paperwork or transferred paperwork ownership temporarily to the bank, bank can sell it off under the contract of the loan. So this is increase in the claims of business. All increases in the claims are shown by the word debit. Another is loan from bank. It decreases. When does loan decrease? When you repay it. You have done the repayment of loan. When you repay the loan, that means the bank no longer can have a claim on your business. Therefore, bank's claim on the business go down, which is the alternative of that. The other side of the coin is that businesses' claims are now going up because an external party does not have claims anymore on the business. So you have increase in the claims of business because loan is being repaid. It is decreasing. If it was increasing, we would say credit, but it is decreasing, so we will say debit. Loan being paid, claims of business are going up. Loss by theft, again, it comes into category of expense slash loss. Loss increases, meaning, possibly there was earlier no loss by theft. Now there is loss by theft. In the loss by theft account, you will have to write something. So your claims go down because, theft has taken place. Either the money has been taken away, your claim on that money goes down. Now, you could argue saying you actually have a legal claim on that and you can file an FIR and then legal proceedings can happen. But assuming that everything has now settled and you can't recover this money, that is, the loss. That is when the loss is recognized as well. So it is a reduction in the claims of the business as well. But what is happening here is that all expenses. Now you have to think differently about it. This is an exceptional case. Typically, when you spend a salary on salary, your right goes up. The right or the claim goes up. However, in case of a loss, when you are losing the cash, so the in case of loss, the two sides of the coin are, let's say you lost the cash, but you lost the cash because there was a theft, loss by theft. All right. So you no longer have right on the cash. So which will be represented by a credit, a reduction in the claims, but an opposite debit has to be shown in the books of accounts as well to say what was the cause, why did you lose this cash, and since there is no obvious reason, I mean you did not buy any right over the use of anything, it was just a loss, but an equivalent debit has to be created. So in this case, we're going to still say debit. The decrease in the claim is going to be for the cash. So decrease is in terms of cash if this was cash lost. However, in this case, a debit has been given to loss by theft because we don't have any other option. We're not earning any right. So we're just creating a dummy account which is loss. We are not earning any right. It's a loss of right account, right? So the account which is being debited is loss by theft account, and what we actually lose is the cash, which is going to be the other side of the coin, other side of the transaction in this case. Same for loss by fire. Let me explain it again because it's slightly complicated. Typically, in case of an expense, for example, rent, when you pay rent, you earn a right to use the premises or whatever property, okay, and you pay cash for it. However, in this case, what is happening is you have a loss due to fire. Loss due to fire, and let's say your goods have been burned. So what you lose is the right to use the goods. Let's say your stock has been fired. So right to use the goods has been, it goes away, it vanishes, is what we are saying, and it vanishes because you lost the goods by fire. When you paid rent, you earned a right to use the property. But when the goods were lost in fire, you did not get any right whatsoever. So there is nothing, no increase in the rights of the business. But since all credits have to have an equal debit, you create a dummy account which is called loss by fire account, and you give it a debit. You show a debit and you show an equal credit for it. So debit and equal credit for it because you lost the goods. So goods show a credit and loss by fire shows a debit, an equal debit and credit. So understand that loss by fire is kind of a dummy account to show that we did not earn any right. Typically, we would say this right has been earned and let's give it a debit, but no right has been earned. Uh, but in order to record this in the books of accounts, we have to create a dummy account which is called loss by fire. Same loss on sale of building, you sold the building and you sold it at a lower price compared to the cost at which you bought it. It's also a loss. Again, all losses are recorded in a dummy, expense account, dummy right account. It does not necessarily give you a right, but you have to show a debit for the equal credit. So again, you show a debit here. And if you remember the rule, which was all expenses and losses, these are nominal accounts, and we're going to learn the rules of debit and credit where we will say all expenses and losses are going to be debit as well. So just wait for that. Okay, creditors are decreasing. When creditors decrease, it means you paid back the creditors. You paid back the vendors. When you paid back the vendors, that means vendors can no longer ask you for money. So vendors' claim on business go down, which means businesses' claim go up. So increase in the claims of business is always shown by a debit. So creditors account will show a debit when you pay back the creditors. Okay, outstanding expenses, again it's another liability. It is decreasing, meaning you are paying back. You paid back the outstanding expenses. Outstanding expenses which were overdue, you did not pay those in time, they became a liability and now you have paid them. When you pay them, these people to whom these expenses were due, they cannot come back to business and claim anymore. So their claims go down, meaning businesses' claims go up. So increase in the claims of business is shown by a debit always. Interest earned. Interest earned on deposits that you have in the bank account. So when interest earned is going up, what is happening is you are receiving an income. It's a non-operating income, but you're receiving an income and you're receiving cash for it. The income's name is interest. Oh, sorry. Interest income, and the other side of the coin is the cash. So you're gonna get cash, but in exchange for the other side of the coin, in exchange for receiving this cash, what you've done is you have foregone, you have given up your right on the interest on the bank deposit, right? So you do not have a right anymore. You do not have a right on the interest on the deposit because that interest has just been paid to you. So again, you have to think a little bit slowly about it. The two sides of the coin. You deposited money in the bank account. Now you have right to receive interest, right? So interest on deposit. This is the right. And now the bank has paid you in cash. So this right has been redeemed by you. You already got cash for it. When you got cash for it, this right goes down. You don't have this right of receiving the interest anymore, right? So think a little bit differently here. Interest earned is an income. When you receive the income in cash, you are giving up your claim on that income going forward, at least for the duration for which services have been rendered. So you put money, let me illustrate it a little bit more. So let's say from March to September, 6 months period, you deposited 100 and you deserve an interest of 10%, right, for the 6 months. Now during this time you have increase in the claim. Interest on interest on the deposit. Interest on deposit. Now bank pays you against this interest on deposit. The money has been paid to you. Now this right goes down. Now this right has been cancelled. The bank has paid you the cash. So your claim is going down because you have been paid cash for it, is what I mean. So in order to show that you have earned the income, we are saying your right on this income is going down. So you're going to say credit. Again, the opposite, the other side of the coin is that cash that you have received. Your claims go up there. Alright, so let's summarize the learnings from this tutorial. I have the accounts that we discussed in the first column, then type of account and category of these terms from the previous couple of videos and tutorials. So this we already knew. The new thing is when it changes, what happens? So cash being an asset, when it increases, you show it by debit. Bank balance being an asset, when it decreases, you show it by credit. So like this, what are the key learnings from this tutorial? So here you go. So all the assets, you have all the assets here. When asset increases, increase, it is shown by debit, debit, debit and debit. And whenever the asset decreases, it is shown by a credit. That is the learning from this slide. Next up, you have incomes. So sale is an income. Whenever income increases, you have a credit. Interest earned is an income. Whenever income increases, you have a credit. Then you have expenses. Expenses, whenever expenses increase, you have a debit. Expenses increase, debit, debit and debit. So whenever expenses are increasing, you write it as a debit. And finally, the liability. Liability goes up. Liability is shown by credit. Whenever liability goes down, it is shown by a debit. Okay, which leads us to the following learning. Any increase in assets is debit. Any decrease in asset is of course opposite. So you only need to remember, one of these two. Any increase in income is credit and opposite is debit. Any increase in expenses, debit, and decrease is credit. And finally, increase in liability is a credit and decrease in liability is shown by a debit. So there you go. Now you know different types of accounts: personal, real, nominal. You already knew assets, liabilities, incomes and expenses. So this is how we are building up: asset, liability, incomes and expenses. And we also learned the subcategorization of this. And after that we learned the types of accounts, which is personal, real and nominal. And then we learned about debit and credit, and how increase or decrease in asset, liability, income, expenses will be shown by debit and credit. That's it for this tutorial. I'll see you in the next video.